stocks this week, we'll tell you what it takes to build a perfect stock portfolio. Paras Aidinwala picks Diwan Housing Finance and Cholamandalam Investments as smart options for you. We'll find out why. And with the rupee weakening to a 4-month low, we'll tell you what you should be doing with your IT stocks. Welcome to All About Stocks. You're watching ET Now. We've had a slightly rough week on the markets, the Sensex ending below 17,000. The rupee today is weaker than it has been for 3 months. On this show, we'll tell you how you can plan a portfolio that won't rock too much when the market stumbles like this one or the other week. And we'll also tell you how you should pick the perfect stocks for those portfolios. Remember, there's an email ID at the bottom of your screen and you can reach us on our Facebook page as well. Now, before I bring in our guest who will tell us how to plan that portfolio, Navneet is here with the latest on the markets and the rupee. Navneet.
It was a bad week for the markets. If you look at Nifty, that closed down 2.3%, Sensex closed down by over 2%. Even the broader markets were down by about over 2%, mid cap as well as small cap BSE index, and Bank Nifty too closed by about over 3% down for the week. Some of the counters which held up during the week were TCS, Cipla and HUL. All these counters closed in the positive territory by over in the range of about 4 to 6%. Well, rupee depreciation played spoil sport during the week. And if you look at the policy changes, these are the fears which are there in the market because of which the rupee has been falling. And if you look at the currency and the rest of the Asia have also been sliding, and rupee has been the worst performing currency in Asia. It slipped by around 2.2% for the week, and it was the straight 5th week decline for rupee. Outlook remains weak as even despite central bank intervention, the slide continues, and the market is keenly watching the level of 54.30, which is an important level to see if that breaches, the rupee could slide down further to 55 marks.
Thanks, Navneet. Joining us now is Paras Aidinwala, the Managing Director of Capital Portfolio Advisors. Paras, it's always a pleasure to have you on this show. And I'm glad we have you here because we're doing a back-to-basics show. Now, the point of this show is to help us build a stocks portfolio from scratch because we get so many emails from viewers who are worried about the portfolio they have. They don't know if it's working for them. They don't know if it's sufficiently diversified. So tell us, ideally, how many stocks should a retail investor with a long-term horizon have in his portfolio?
It depends on a few factors. One is the investment horizon. Second is the amount of return that they would like to have. Third is the amount of risk that they can take. Fourth is the liquidity parameter. So these are some of the factors that one needs to really take into consideration. It also depends on the size of the portfolio. So, for example, if someone is looking at a return of say about 15%, assuming an inflation of about 12%, that is on CPR basis, for a portfolio of up to 25 lakhs for a 1-year horizon and a 15% expectation of return, I think anything around up to 10 stocks, anything between 5 to 10 stocks should be okay. But at the most, even for larger portfolios of 50 crores or 75 crores, I think it should not be anything beyond 35 to 40 stocks.
Paras, if I'm building a portfolio, I obviously have to start somewhere. Now, assuming we're talking about retail investors here who have a 3 to 4 year horizon, who are putting away their life savings, they have moderate expectations of return, would you say a core holding is a good place to start? Can you explain to us how we should find that those stocks that would make up our core holding?
Core holdings are those stocks where investors are most comfortable with, not only with the quality of management, not only with the kind of business that they are in, but also with the kind of growth prospects. Third is the leadership position in the core holding. The company that we are looking at identifying should be among the top 3 in terms of the leadership positions in its area of business. The fourth is clearly the strength of the balance sheet. The balance sheet has got to be very, very strong and robust. If it's a leveraged balance sheet, it indicates some weakness in the business and some weakness in the nature of business that the company is dealing in. And to the best of possibility, a business that is low leveraged or modestly leveraged or non-leveraged, I think these are the businesses that one can look into.
So you name a few stocks right now that you think could form a part of a core holding for a retail investor?
Sure. The first name that really comes immediately to my mind are the HDFC twins. HDFC Limited, which is the leader in housing finance segment, if you apply all the parameters that I mentioned, they are clearly in your favor in HDFC. And valuations may be a little stressed, but if one is buying with a 2 to 3 year perspective, I think valuations are not stressed, and there is scope for making above inflation returns in the stock. The second is HDFC Bank, which has again shown a tremendous consistency in growth in the past, and the visibility continues to be very good for the future as well. So that's number 2. Third is a company which is not a finance company. That's Asian Paints. This is again a company which is the leader in the paint segment, has demonstrated tremendous amount of growth in the past, and even the visibility for future is very good and has tremendous amount of pricing power in the market. One more which I may want to really name is Bosch India. Bosch is a multinational and it deals in auto ancillaries, and it has tremendous amount of leadership position, has superb balance sheet, has very good proactive management, and I think the valuations do seem a little stressed, but again with a 3 year perspective looks tremendous.
Right, and after we've built that co-holding, if we want to take it to the next level and diversify, would you recommend we go by market capitalization or by the growth prospects of the company?
One needs to buy into high growth portfolios, irrespective of whether the stock is very liquid or is very large or small in market cap. And to my mind, best growth today is made in stocks that are either in the mid cap category or small cap category, where the growth trajectories are at least in multiples of the large cap stocks.
So those were the pointers on how you should be building your portfolio. We hope you jotted those down. We have a question that's coming from Suresh, and this is part of our portfolio segment where we look at his entire stocks portfolio. And he has sent in his portfolio. Paras, he tells us he can hold for a couple of years, but his stocks are not doing very well, and he wants to know what he should be doing with this holding now. I'm going to take them one by one, and I'm not surprised he hasn't made too much money from this portfolio. The first on his list is Kingfisher Airlines. He bought Kingfisher at 98 rupees. Do you think it's time for him to pull out of this stock, because he has held it for far longer than other investors?
Airlines per se, as a business are not particularly great for investors. I would rather be a good customer of an airline rather than be an investor in it. So Kingfisher, looking at the kind of problems that it is undergoing, my sense is that on an uptick, on any piece of good news that might come out, either for the airline industry or for the company in specific, I think it would be a good time to really exit and redeploy those proceeds into some better business.
The next on his list is DLF, which he bought at 576. It hasn't been doing as well either, but for a long-term perspective, do you think it makes sense to hold on to DLF?
Yeah, if Investors Horizon, as he explains and mentioned, is nothing less than 3 years, then it is very much possible that DLF might kind of move up from the current levels. While the cost price seems to be quite high, my sense is there is a clear possibility of reduction in losses over a 3 year period. The company is a leader in the real estate segment, is trying very hard to improve the quality of balance sheet, and my sense is it should be able to do that. So at the current levels, my recommendation would be to hold on to DLF.
Indian Oil Corporation, 25 stocks, bought at 403. What would you recommend?
Any business that is directly linked to the government or has government ownership clearly has a problem. I think there is currently problem of inactivity on the government side, or there is clearly a problem of populism. And therefore, any escalation in cost of doing business or escalation in raw material costs, for PSUs like Indian Oil, are unable to kind of pass it on to the customers, and therefore the losses can only increase. So my sense is it is better to get out of Indian Oil on any rise that you might see. It is very much possible that the government might decide to increase fuel prices, in the immediate future. That would be an excellent time to exit out of Indian Oil and buy into something which is much more predictable.
Moser Bayer is the next on his list. He's obviously not put this portfolio together according to the rules that you just talked about. Is this also a share that he should possibly be getting out of?
It's a clear exit. I think Moser Bayer, which was into the DVD business earlier, then diversified into solar business. So it's always been getting into businesses that are that have very low entry barriers and are highly capital intensive. and generate very poor returns on business.
NTPC, which he bought at 193, what would you recommend on this one?
NTPC may generate some returns on investment, but can it generate returns which are above inflation? The answer is not. And I would recommend exiting out of the business.
And finally, GMR Infra, which he bought at 150 nearly, not doing well either. Would you recommend he books out of that last one as well?
I would rather use the services of an infrastructure developer rather than be an investor in it. I do not expect great returns emanating out of such kind of infrastructure businesses. And therefore, on any rise that you might see, I think it would be a good idea to exit out of it.
All right, Suresh, that's the advice you're getting right now. Remember, Par is telling you there to hang on to DLF and possibly book out of all the rest of the stocks that you have on your list at this moment. All right, on the other side of this break, Paris is going to bring us two more stock picks for the week, Divan Housing Finance and Cholamandalam Investment Finance. We'll find out why we should be buying these stocks right now. Stay tuned.